Hello and welcome everybody to Broker's Playbook. Broker's Playbook, once again, is the show where all our brothers and sisters across North America can find value in the guests that we bring on, as they are either leaders in the industry, top performers in the industry, or affiliated to the industry where they can make a difference to make what we do better and more valuable. Today, I have the pleasure of bringing on one of my mentors, one of my business partners, my broker of record, and that is the broker owner of the Signature Realty family. And Chris has been, and his brother have been leading this organization for the last 15, 20 years, I believe. And they are a legacy family in real estate, generational in the city of Toronto. And I couldn't be prouder to have you back on the show and to get your extremely deep and unique sight on things. Welcome to the show, Chris.
Thank you. Glad to be back and appreciate the opportunity to chat.
For those who've never had the pleasure of hearing you speak before, if you may please just start quickly with a 2-minute wrap of kind of where you come from and how long you've been in this business.
Sure.
I try to find typically real estate nerds that can outshine my nerdiness in real estate. Like I love numbers, but there's guys who love numbers, there's guys who love numbers. Mr. Slightham, please give me kind of a little bit of that depth of your family's involvement in real estate.
Sure. Yeah, absolutely. No, I come by it honestly. We have, we're third generation now, my brother and I, in this part of our business. Our great-grandfather and grandfather were builders in the city, evolved into brokerage. We've just celebrated our 60th year in the real estate brokerage space.
And congrats to Ted and Wendy.
That's right.
They were glowing that day.
Yeah, it was fun. A lot of fun. We had a great event. And here we are, right? And we've evolved with the city. We've evolved with technology. We've evolved with data analytics. We've seen a lot. And we've ridden through many different ups and downs in the course of the last 60 years. And so the benefit we have is that experience and now our ability to relate today's behavior of the market to other points throughout history and give a little more confident view, I think, of things because of that. And we love the math. You were joking earlier about, us real estate nerds, right? I mean, look, data is hard to beat, right? I mean, you've got to have the right data. You've got to know how to understand it.
Well, that's the right? thing. So today, I kind of wanted to we need to decode the market.
Yeah.
We have a plethora of data, the interpretation and implementation, more importantly, of what we do with that data is what counts.
Yes.
You can have all the data, like the internet has really brought data everywhere, but not everybody knows how to look at it, how to interpret it, and more importantly, how to implement it.
100%.
You mentioned in 60 years, your family has weathered a many of storms. And I want to bring specific focus to today's time because this market right now is the most challenging in 40 years, outshining in negativity the late 80s, early 90s, which was the last time in the last kind of deep scar that people have to this day still talk about.
Yes.
In only a few months ago, we found out that we've, hooray, we just beat the worst recession in recent memory.
Yeah.
So I think, and it's nice sometimes to laugh at yourself, at the industry, at what we've become, but it's important to understand how we got here.
Yes.
And more importantly, how can we get out of here,
Yes.
not unscathed, because nobody's unscathed at this point, but how we can survive it and set us up for success to thrive once more in the near future. So decoding the market and building a business of growth and resilience is what I want this time together to be
Great.
about. You specifically in preparation for this show told me that you found an extremely interesting statistic that truly tells the story of the last 3 years in no uncertain terms. And it's a slide that we're going to springboard into different topics, because this one slide, I agree with you, after review,
Yes.
it tells not only the story really well, we can complete the entire exercise and picture using this single slide.
Yes.
So I find it, again, I expect nothing less from you. And let's dive into what this slide is. If you, I have it right here as well.
Absolutely.
You probably have it memorized.
Well, pretty much now. I mean, I've been reviewing.
But here, you can hold on to this.
I appreciate it.
Tell us what this slide is. And of course, anybody who is going to be looking to find it, shoot us a message at anywhere you find Broker's Playbook, whether it's on the podcast commentary, on my socials, the Broker's Playbook socials, or myself directly. If you need access to any of the resources we talk about today, they are available. And the extended version of the show will be in the Broker's Playbook community, members only. And we look forward to serving that community as well. But let's get started, sir.
Yeah, absolutely. So what the premise of this was, I was really curious about demand or need for housing. So what's happened here, as we know, in the last 4 years is, COVID happened. There was a big panic, rightly so, uncertainty. Interest rates dropped purposefully. The global banks made a decision to make money cheap, so that they could allow the world to kind of function while people had to lock down.
It was a closed economy, but it had to function. So they let money run amok.
You got it. And so we know what happened from that. As we came out of the uncertainty that COVID brought, which was, okay, now we have vaccines, whatever you want to call them these days. We won't get into that debate, but it allowed us a path out of the scariest times that we've had in modern history from a health standpoint. And so we had a massive, boom in 2021 due to basically free money availability.
And that was the record-setting year of all time.
Of all time for number of transactions. Yes.
For number of transactions.
Yeah.
So, again, just to peel that back 1 second, I got into the business in 2006, unlicensed, selling businesses.
Mm-hmm.
By 2007, I saw the opportunity of real estate being a part of businesses.
Yes.
And I'm referring to restaurants. I was born in the restaurant business. So I was selling restaurants all over the place. And then I was like, well, I own the building too. I want to sell it all. Well, I need a license for that.
Yes.
So I get licensed since 2007. So my entire career of almost 20 years has seen a trajectory upwards. Mm-hmm. So anybody in the business, 20 years or less, has never, not even remotely close, to have felt what we are living for the last 2.5 years. And this is exactly why I want this to be paid extremely close attention. We had the blip. South of the border was a disaster.
Yes.
We did not feel the effects of that.
No, in the global financial crisis.
We did not.
No.
We had a 6-month. I remember it. I was freshly licensed.
Yes.
I saw the panic in everyone's eyes because it was reminiscent of the late 80s and early 90s.
Yes.
And I remember your view on this, and I remember the discussions at Donalda because the brokerage was much smaller back then.
Yes, it was.
And I remember it like yesterday, where you had spoken about, cash reserves.
Being prepared.
Being prepared as an agent. We're in a business where it's always uncertain. We're in business for self.
That's it.
There is no paycheck.
Nope.
You don't do deals. You don't do business. You don't get paid.
Correct.
Full stop.
Correct.
And I remember that like yesterday.
Yeah.
But the trajectory, regardless of the 2016 little burp of the Ontario Fair Housing Act and all the little things, we go into a frenzy.
Mm-hmm. Mm-hmm. It's a good word for it.
Then when the frenzy and the music stops and the government sees what they've done, basically they created a monster where the average Canadian in that 4-year period, not for a year, 2.5 year period, half the country's mortgages were written at in and around 2%,
Yes.
which only means that in the next 3 to 5 years, they're going to be renewing. And between January of 2022 to last year, June, we saw 11 or 12 consecutive increases of a quarter to half a point per period in order to rein down the frenzy.
Yeah. And in July of 2022, it was a full point move. So
In one cycle.
move, right? And that's the point at which that things really turned. If you look at the charts that we do and study, and you'll probably have them up as we're talking about them, you'll see that moment in time and what it did to transaction volume in particular and prices as well. That was the 1 month where there was a significant shift at one moment in time. It was July of 2022. It was a 100 basis point move. First time in Canadian monetary history since rate setting started in 1932. First time they'd ever moved it that dramatically, right?
Because they went a quarter, half, and nothing happened.
Correct.
People didn't pay attention.
No. Inflation was still climbing.
Yeah.
Inflation was still climbing. So they had to hit
and it was
the
what,
brakes.
5.5, 6 points at that time.
It peaked at 8, right?
It peaked at 8, but at the time it was 5.5, 6 reporting.
Yeah.
But they were saying the real inflation number, which includes the other half of the equation, it was at 11 or 12. So there was a big reason to do so, and they did get people's attention.
That hit the brakes.
That hit the brakes. And when we say hit the brakes, what we're living today and what the problem is today, and we'll get to everything in its own category per se, but rates right now are 2.25. Rates are not the problem.
Oh, right now, I mean, rates, yeah. I mean, our 5-year money here in our market is 3.7%.
So rates are not the issue.
Not an issue at all.
What this entire exercise did is it eliminated confidence to the point where people don't even know what it looks like if it returns. I have never seen
Yes.
a drop in people's psyche
Yeah.
to this level.
Yeah.
When you walk in the grocery store, you know people are contemplating how they're going to pay their bill at the till.
Yes. Yeah.
Like, I don't think it's like a dramatic comment to make.
No, you're right. It's not. I mean, it's really not. And I think that the unfortunate, kicker that we had here to pile on top of this massive post-COVID rate swing, of course, is the trade renegotiation that's going on globally, right? Which happens to be led by our number one trading partner, which happens to affect all parts of our economy
In a very significant
way. So I'm the first to admit that coming into 2025, I was actually quite excited about the future. We were returning to growth because if you look back to October and November of 2024, transaction sales, we're talking sales volume here, just unit sales, had jumped 44 and 40% year over year in transaction volume. Then, of course, the election happened and inauguration happened on January 20th of this year, 2025. And the first thing that President Trump did was he said, I'm going to reset all trade globally.
And not a single word was said during the race.
No, it was it started to come out towards the end of the race and as they were coming into, once he got elected.
Correct.
He started talking about it, right? And then, people say, okay, well, we've heard this before. He did a bunch of renegotiation during his first, term that he was in. And so
he renegotiated NAFTA into the U.S. Mexico-Canada agreement in his first term.
So we sort of knew that there was something, but nobody truly had any idea. And I mean, nobody, like federal banks, the biggest, smartest economists. Nobody saw this coming to this degree. And our country, in particular, in Canada, our market, of course, has a significant, effect. And that's really what we're dealing with today. And that's why I think interest rates today are not the issue.
Confidence.
Right? It's confidence. Interest rates were the issue because it was a dramatic adjustment in terms of high transaction volume, and then rates were dramatically low and then dramatically high, and they've reset. Rate, like, you have to remember, 24-ish months ago, 5-year mortgage rates were over 6%.
That's right.
Now they're 3.7 roughly right now.
Well,
so that's not the
in
issue.
2006, just because I mentioned it's the year I got into real estate, I bought a home at Victoria Park in Danforth.
Yeah.
Just outside of Greektown, going into Scarborough.
Yeah.
I bought the home for $300,000 even. My rate was 5.05, and I thought I robbed the bank.
Absolutely.
Like, that was like me with my connects and like, yes,
of course. Can you
it's real.
You got to go back. Like 9% is something like the average for the last 50 years, or some crazy number like that. But it's so at 5%. I mean, at 3.5 right now, roughly 3.7. That's incredible.
Yeah, it's great.
Incredible levels.
It's great. So, and the opportunities that are being born inside this market is something we're also going to talk about, is how to identify them for the right client.
Yes.
And how we'll get into that.
And then the other change I just want to mention, so we don't forget to talk about it, is immigration.
That's right.
Has been a major change. And so when I did this
because we're in
chart,
net negative now.
Yeah, correct.
Yeah.
So when I did this chart, this is what started sparking. I'm like, okay, well, if our immigration levels, which, need for housing changes, like what does that mean? So what I did was I looked and I said, well, let's combine, which we don't do this. We don't talk about this. We haven't talked about this ever in the past, really, from a charting standpoint. We just did it. Let's combine rental volume transactions and sales transactions of the Toronto Regional Real Estate Board and see over the last 4 years what's happened. Because I was curious. Like, I didn't know the number off the top of my head. Now I do, which I think is important, because what we found out was in 2022, there were just over 99,000 in the first 3 quarters, because we have the first 3 quarters of the year data so far, because the rental data is only released quarterly. So that's what we can work with. So we matched it up and said to the end of the 3rd quarter in 2022, there were 99,000 units of housing transacted, rental and sale combined. This year, there's 105,000. So 6% more in 2025 than there were in 2022.
But there's a drastic difference between rents
There's the
and
treat.
solds.
There's the treat.
There's the treat. So why don't we let the cat out of the bag?
Yeah.
Give me the numbers 2022 sales versus rental.
Right. So sales in 2022 for the first 3 quarters of the year, 62,638 units.
Give me the sales this year.
47,727.
A reduction of about 25%?
Yeah, I think close to it, right? Got to do my quick math. That's a trick.
No.
But I can tell you this, it's 15,000 units, right?
24%.
24.
24%.
Yeah.
Now, here is the crazy part, because this is now going to tell the story of the market.
Yes.
What were the rentals in 2022, and what are the rentals for this year?
That's fascinating. Isn't it? Like 36,679 rentals for 2022 in the first 3 quarters of the year.
2025.
57,705 units. 57,705 units.
57% swing up.
Yeah. Boom.
So for rentals for $100, who wants to guess how the absolute 180-degree swing of those stats, why and how? And I think we answered the question between the economy adjusting before it even touches to catch its breath, because it was doing better.
Yes.
I could share more anecdotal, but I won't for the sake of time, and it doesn't do much more than what we've covered. things were going a certain way. They just barely caught a breath between the south of the border election and the full-blown assault on free trade globally. But as it relates to us in North America, in Canada and Mexico, a full-on war on free trade is what this is. It's the exact opposite. It's tariffed, let alone, an excise tax, let alone surcharges, duties. We're talking full-on tariffs blanket. It's insane. That caused manufacturing, industry, warehousing, commercial, retail, spending habits. I went into a convenience store 2 weeks ago, and I was like, do you guys have cases of pop? I needed mix to go to a party. I was supposed to pick up ice and mix.
Okay.
And he goes, yes, but it's U.S. pop. I'm like, sorry, what does that mean? Like, what are you talking about? And I look at it, and it's a can of Coke, but it's U.S. pop. I chalked it up to, I didn't understand maybe what the gentleman was saying.
Sure.
I pick up the case of pop. What's a case of pop? $10 at the convenience. It's $8 in the grocery store. It's $10, $12 at the convenience store. Sure. It was $19.
There you go.
So I said, sorry,
there you go.
so I don't know what I bought. The guy says $36.
Yeah.
Hold on. Cheetos and Coca-Cola.
Yeah.
In a bag of ice.
Yeah.
He goes, yeah, I told you it's U.S. tariffs. I don't know if it was a unique circumstance, if it was his way of surtaxing me.
Sure.
Whatever the case may be.
It's real.
It's real. Immigration, we just started talking about, gets cut to where, without the temporaries, without the student, whatever, we don't need to do an immigration analysis today, but we know we went from almost a million.
Over a million, too.
A million two in the last year of the previous government to a net negative number in 2025.
So what's interesting, and I'm glad you made that point, because what I thought was happening is that total transaction volume, total need for housing, you would think, well, if they're not inviting more people into the country right now, we don't need as many houses, right? So that's why we've got a slower market. It's not the case. It's not the case. We're doing more. We're filling more need today than we were 4 years ago when immigration was at its peak. So that to me means we're just catching up, because this is part of the underlying reality of our marketplace. We're just catching up, and there's still people settling into our region. And so the need for housing exists today still. And I think that's what is so important for all of us in the industry, as brokers, as investors, as homeowners, as developers, that we need to appreciate that the actual demand for housing
has never been higher.
The only thing is the makeup of what people are choosing to do right now, while there's
able to do.
Great point. Is just, look, I'm going to rent instead of buy until I determine, that I'm confident that my job is safe, that the industry I work in is going to make it through this tariff war intact, and life is going to carry on. And that's what I think this is what I want to determine. I think what we've determined by doing this analysis is that the need for housing really hasn't changed at this time in our region.
So I think that, and again, I have my notes here as some of the findings. The affordability redirect. Buyers who couldn't purchase became renters.
Yes.
That's an easy thing to say, but if we were to peel that onion just one more layer, the cost of home ownership today is about 30 to 35% higher than that of renting. So if I were to purchase that same condominium, that same townhouse, right now, the value of that I have to pay to acquire it, the carrying cost of the mortgage, the fees, the this, that, and the other, are well above renting in many areas, not all areas.
Not all areas.
Not
Some
areas.
are starting to get better.
In some areas, it never lost their value to begin with.
Yes.
So I'm saying on average, when we see, this cluster of supply
Yes.
in the downtown core,
Yes.
in a specific asset class, which is the micro units, which is
Yes.
those 450 to 600 square foot units that people paid up to $600,000 and $700,000 for. Well, those have been readjusted to 550.
Yes.
We have seen condos sell in the 400s again,
Yes.
which people thought that would never happen.
Yeah.
Well, tell God your plans if you want to laugh.
Yeah.
So, the truth of the matter is the affordability redirect is real, and the proof is in the pudding.
Yeah.
People are doing it whether it's consumer confidence. They need to wait and see. Typically, waiting and seeing means moving with the masses, which once again brings the other fundamental of real estate. When people are fearful is when you make your move.
100%.
If you're in it for the money. When people are all over it is when you run.
Correct.
And this is Warren Buffett's most famous words, saying when people are fearful is when you buy, and when people are confident is when you sell.
Correct.
Because the masses always need to see the proof before they move. Most people are not built with risk tolerance above a certain level.
Yes.
So it's not to say that they're less intelligent or
No.
you're smarter or anyone.
Not at all.
It's a matter of risk tolerance. It's a matter of where you come from and what you've been taught. And not everybody has the same ability to make those decisions.
There's only one Warren Buffett.
That's right. That's right. That's right.
Right.
That's right.
And look, it's. I think the cool thing is to note is how incredible our city and our region and how resilient our region is, right? It's because when you see the transaction volume that high, people want to be here, right? People want to be a part of this marketplace, which is fascinating. And I know we're speaking, or your Broker's Playbook is across North America, and I think what I would suggest as a takeaway is everybody should do this exercise for their market.
Well, I can tell you that any
analyze it, right?
franchise city, any urban,
Yes.
big urban, any urban center, you can look at Orlando, you can look at Miami, you can because I have many friends all over the U.S.
Yes.
New York, my God, Chicago, Los Angeles, I haven't looked at, and I don't know many people out there to get that anecdotal information from the street. But Vancouver is in worse shape than Toronto as far as this pendulum swing the other way.
Yes.
So I can't imagine Los Angeles would be much different. But if anybody is from the Sunshine State, California State, please get back to us with some of that data. We would appreciate to have it. I want to ask you, and I want to take this into what that means for agent productivity and commission splits. To give the audience an idea of kind of your data set, you are either the biggest or one of the biggest brokerages in terms of agent population with just under 2,000. You have 2,000 agents reporting their results to your office. What have you seen? What have you seen as the biggest? What's your biggest takeaway or your biggest shock, or what do you see?
It's not really a shock, Simeon. I think the reality is this, and we've seen it through every cycle. And that's why, when we entered this cycle, we were confident that we knew how to manage it. And we have, our group here has managed it very well because we've said it from day one, is that whenever there's a change, you have to stay engaged. So you have to really dig deep into the market. You've got to understand data. You've got to stay connected to clients. So anybody that has done that has either maintained or grown their business in a market that is technically contracting from a sales standpoint, right? And so we've seen that. So no real surprise there. What we have been a little bit surprised about is actually the rental volume. So we felt people would obviously would make a shift to rental
but this
number is incredible. And the fact that we're doing more transactions today as our Toronto Regional Real Estate Board are doing more transactions today than 2022 that was surprising when we got this math put together. So it's the shift. But what happens in a market where you don't have what I call like a tailwind of activity, where things are just, transacting, things are rolling along?
There is no more order taking.
No, there's no order.
There's none of that.
So it's a skills-based market.
Yes.
Right? So you have to know how to communicate. You've got to know the data inside and out. You've got to know the micro market data. So not just the high level stuff. You've got to dig into the neighborhoods you're dealing in. You've got to dig into the product type you're dealing in. And you've got to figure out the math, months of inventory on that product type, not just on the overall market in that particular area, and to help guide your clients to making really good decisions. Because, look, not everybody's in a position to buy real estate today, but anybody that is, if you look at where we were from a transaction, from a price standpoint to where we are, there's been a healthy correction. You look at the cost of borrowing today, brilliant, and you'll see that the difference between in February of 2022, mortgage rates in February 22, I just looked it up, were roughly around 3.3% for 5 year. Well, the average sale price in our market was $1.33 million. Well, today we're at $1.05 million, and interest rates are 3.6. So that's a pretty good story, to say the least.
It's an excellent story.
So
it's a tremendous opportunity.
And you look at certain micro markets or certain types of product within our market, like you mentioned there, condos, the smaller condos as an example. They're well below. You can buy them well below replacement value today, like 100%. 35%. Like you can't build them.
Well, that's a huge story for new construction and pre-construction right 100%. Now. There has been, this is the record of all record years.
Absolutely.
On the unfortunate side, there has been more condo cancellations, project cancellations this year than ever in the last 20 years.
Yeah.
Which is also going to create the market of the future, which is, I'm not going to say it's a good news story, because it's never good when the pendulum swings from one extreme to the other.
No.
But in 2030, 2031, remember these words, because it's actual impossible to not happen.
Yes.
There hasn't been a crane lifted in 3 years.
Yeah.
That is going to have its own consequences.
100%.
Because once the market finds its rhythm, immigration does start coming back in, and they start opening that door again, they're going to find a market with no new inventory being delivered. And that's going to go back to the old, same white-hot pre-construction markets, which cause speculation, FOMO, nonsense, and the vicious cycle repeats. That's the stuff that I don't like. Going back to this and going back to this year right now, this morning I had the pleasure, because you are my broker of record, I made it your brokerage, I had the pleasure of being on Signature Live, which is you do 2 shows a week speaking about what's going on. What is your message to your agents? What is your message to our brothers and sisters at every brokerage North America wide? Because everybody's living the same type, more or less. How does a broker adapt? And I don't want to use top producers or big teams. I have a big team, so it's different, a little bit different for me. We have more of an investor focus. But the average agent that does 8 to 15 deals a year used to do 8 to 15 deals a year. Right now, they should be doing 5 to 8 based just on stats. Should they be picking up that 40% more in rentals to be able to work out a year that's still as successful and as profitable? What is your advice there?
100%. And I think that, the opportunity lies from a transaction volume standpoint. If we just talk pure business, let's like bottom line stuff, you have a cost of living that you need to cover, right?
Yes.
And if your income has gone from here to here, that's not easy, right? It's very stressful. And so those agents,
it's very stressful, because I will say I'm living it.
100%.
I went from a very new construction focused business to readjust. Massive pivot.
And you did, right?
Of course.
Yeah.
But like, I want people to hear and really feel there's nobody that has come out unscathed.
No. Nobody.
There's no time for pretenses. There's no time to lying to yourself is not going to help.
No.
The advice that you give is, what do you take? What, do you make adjustments on the back end? So like reduce your cost of living, increase your workflow. Where do you see?
Yeah, that's the formula, right? Is you have to adjust your overhead in all areas of your life. And then you've got to dig in and talk to more people, Simeon. That's the bottom line.
Prospecting.
That's the bottom line. You can't cut your way out of this market.
No.
Right? You have to improve your consistency on connecting with people. That is the only way you're going to maintain. And look, hey, there have been people that have grown their businesses in the last couple of years, because they really listened, they really hunkered down, and they really engaged deeply with people, because consumers are like, we do this all day long. So, we memorize these numbers. We know it inherently. We feel it. But you have to remember, all your clients are wondering what the heck is going on out there.
They don't have that insight.
They don't have that insight. So just by being an educator is a game changer. But you've got to be an educator to more people than you ever imagined before. And if you do that, it's going to do a couple of things for you. One, you're going to unlock opportunities where people need help in transacting, and it could be leasing, it could be selling. Either one, doesn't matter. But it's business. It positions you ahead of the rest of the competitors out there who aren't doing these things. So as the market does return, as growth does return over time, you're ahead of everybody. So your market share capture is happening even when it might not feel like it, because it's tough, right? But if you're talking to more people today, that old saying, cast your net wider, or whatever you want to call it, a kind of cliche-ish, but that's the bottom line. You've got to talk to more people consistently every day. And what I said today to our team is, look, when you're planning for the next year or two, do not be waiting or expecting transaction volume to increase dramatically.
Because it's not.
I don't think that's a wise approach. We can hope all we want.
Yeah.
But what I want everybody to do is say, okay, if I used to speak to 2 people a day, it now needs to be 4 or 6. If I used to speak to 6, it now needs to be 12 or 18. This is, and if you're willing to do that, and this is not easy. It is not easy. There's a lot of pressures in life. I get it. But if you're willing to say, okay, I am going to be accountable to myself. I am going to speak to more people every day. I'm going to do more open houses. I'm going to do more social media posts. Video CMAs or something that big.
Omnipresence, presence
everywhere. You will come out of this, because I can tell you from our experience over the last 60 years, we're better today than we've ever been, because what we did in the times that were the toughest is we dug in and we did more.
I've never received more referrals than I am right now.
Right.
People are looking for skills and people who they know are going to answer the phone when the chips are down, right?
That's it.
We've been helping our clients a very specific way. We call it world-class service for a very long time.
Yes.
That's paying dividends right now as we've pivoted into an absolute resale strategy in the lack of new construction business. So what I'm going to do is this. I'm going to close off this portion with kind of the essence of what we've talked about. And the fact is that over the last 3 years, we've seen a 25% drop in sales transactions. We've seen rental transactions shoot up almost 60%, at 57%. And the total transaction volume for all the naysayers, remind them that housing is up 6% in transactional volume. So people are not sleeping. People are choosing and making different decisions based on the psyche that they have, the confidence that they have, and the financial capacity that they have. And that's what this story is. I believe those statistics can be used as a roadmap. And in the Brokers Playbook Academy exclusive, where we're going to next, this is for my core VIP membership group. These people are extremely stat focused and growth focused. And what we're going to cover in there, and for anybody who ever wanted to, get into a community of people who, it's camaraderie, it's people who coast to coast, who kind of help lift each other. The data that we're going maybe, I'm going to say it again, we're going to be a lot nerdier. So we're going to be looking at which property type saw the steepest drops, relative stability, price bands that maintain transaction velocity, those that stalled, how to position yourself when the neighborhood drops 45% in volume. You can't stay put.
No.
Doing the same thing when everything is changing is going to deliver the wrong result. You need to pivot, you need to shift, you need to move. That's what we're going to be getting into. For all of those who stayed with us to this point, thank you for joining us. Chris, thank you for being
Pleasure.
here for everyone. And I will see the rest of you in the BP exclusive.